tonight we're talking about valuation and the identification of market opportunities. Now, before we even talk about that, one of the things that I'd want to do is just a brief recap. I know that these are the usual suspects, most of you guys that are already here. But for those who may have missed the very first presentation that I did, there's a brief recap in here. I kind of decided to take out the majority of the stuff and just talk about the key factors or the key things that you will need to know in order to be able to benefit from tonight's conversation. And it is a conversation, so at any point in time you have questions, please feel free to chip in. You just unmute your mic. I'm not able to see the chat in this mode, so you can just go ahead, and once I hear somebody on the chat, then I'll acknowledge and you can hear your question, or you just hear the question and then ask me to acknowledge or identify you thereafter, or identify yourself. So tonight we're going to do a very brief recap. We're going to look at what is a stock. We're going to look at how people benefit from buying shares, and then we're going to talk about the investor philosophies and the different investor philosophies. And the reason why this recap is particularly important is because tonight we're going to talk about identifying opportunities. And it's key to remember that in terms of the stock market, there are always going to be opportunities in the market, but depending on your philosophy doesn't mean that every opportunity is your opportunity. And we're going to talk about what I mean by that. And then we're going to look at valuation, which is just one of the modes of justification we use to decide on buying stocks. So in terms of a recap, so what's a stock? Now, a stock is simply a security. It's a form of asset, and what it really represents is an ownership interest in a company. There are two different types of stocks. We have the preferred stocks and we have the ordinary stocks. On the Jamaica Stock Exchange, both are listed there, and each of them has a particular advantage or different features when you compare it to the other. So if you look at a preferred stock, for example, the person who buys a preferred stock does not have any voting rights in the at the AGM of a company. The AGM is where persons will go and vote on different resolutions. So if you guys are following the news, you may have heard recently that Barita is doing an APO. Now, for that APO, the stockholders, myself included, had to vote on whether or not we would give the directors the approval for them to go ahead with the APO. Alright? The preference shareholders did not have that option, and Barita has about 10 million, sorry. They have 10 billion preference shares outstanding, and each of those is for like $10. But the preference shareholders did not get a say in whether or not Barita did their APO. The second thing is that the preferred stocks tend to be more stable, so the stock price doesn't run up and down as we will see happening with the ordinary stock. So like the ordinary Barita stock, it's been as high as $100, it's been as low as $30. But the preferred shares are all priced at $10, and the price doesn't tend to change. And this goes right across the board for all preferred shares. The other thing is that preferred shareholders tend to have first dibs on dividends. So before the company can pay its ordinary shareholders a dividend, then it must pay the preferred shareholders a dividends. Additionally, they get first offer should the company go under. So if the company goes under, the preferred shareholders have to be paid before the ordinary shareholders are actually eligible for any form of payment from the liquidation of the company's assets. The ordinary shareholder is pretty much the opposite of that. So he gets to vote at the shareholder meeting. he has no guaranteed dividends, and his stock tend to be more volatile, and that is actually what creates opportunities for the ordinary stockholder or the ordinary shareholder. All right. Next, we talk about the two primary ways that people benefit from buying shares. Most of you already know this, so I can be quick here and talk about capital appreciation, which is just an increase in your share prices above the price that you bought them for, and then dividends, which is a check or a payment made by the company to existing shareholders. Interestingly enough, there's actually another nuanced way in which you can benefit from owning shares, but the Jamaica Stock Exchange doesn't facilitate it. It's called shorting. But like I said, in Jamaica, shorting is not really it hasn't been approved by the Jamaica Stock Exchange yet or implemented. So that would be the third way that I would include here. And then now we can talk, just before we start talking about how we go about doing valuation and identifying opportunities, we can talk about the different investor philosophies. Now, I believe it was in the second or in the first talk, it was the first talk that we did, we spoke a little bit about the different philosophies that exist, that persons can adopt once they decide to get into the stock market. I also mentioned that for me, I'm a value investor, so my approach to investing is to buy companies that I think are going to be in a really good position, say within the next 3 to 5 years or even 10 years out, and I try to buy those stocks primarily when I see that the stock prices have fallen well below where a fair value, and a fair value is typically what we would say the average person or even the analysts within the market agree that this stock is worth. So that's whatever price that the analysts agree that the stock is worth. The reason I mention the average shareholder as well is because when it comes on to fair value, even the average shareholder has an appreciation for certain companies, and understanding that these companies are worth, for example, X amount in terms of its per share price. So for example, we can talk about a Grace Kennedy. A person, for example, would agree that a company like Grace Kennedy is worth more than, say, $1 per share. They might not understand exactly what Grace Kennedy's fair value is, but they are able to appreciate that for a company like that, with all of its business lines and what they do, is well worth more than $1 per share. All right, we'll talk a little bit more about that when we talk about valuation. How do we know that Grace Kennedy is worth more than $1 per share? Then you have the short term or the swing trader, which is a person who is looking to buy a stock today and sell it for a profit, say within 1 month, 3 months, 6 months. Typically, a short-term investor is not looking to hold on to a stock for any number of years. And in fact, a year might be a very long time within the perspective of short-term or swing trading. The next one is the cash flow or the dividend investor, and as its name suggests, this is the investor that is looking primarily for cash flow, and this is going to come chiefly in the form of dividends. So a person like that is going to be looking at probably more stable companies with a long-standing history of paying dividends, and one that has the capability to continue to pay dividends into the future. All right. Next is the day trader, and I don't think we spoke a lot about the day trader in the last one. That's not correct. We did. It's the value investor that I didn't go into as much. But the day trader is a person who is literally looking to buy and sell his stock within the same day. And with the Jamaica Stock Exchange's new platform, that's the JTrader Pro platform, they launched it in I believe it was 2016, 2017, thereabout, day trading has now become a possibility. So you can actually go on the stock exchange. If you have JTrader Pro, you can log into your JTrader Pro profile. You can buy Grace Kennedy at, say, $50 in the morning, and within a few minutes you can sell it back at a price that is naturally you're going to want to sell it above where you bought it for. So if it is that it had gone from $50 to 51 or 57, then you can decide to sell your shares at that point, and that is what the day trader does. An interesting thing to note about day trading, particularly within the Jamaican stock market, is that you're limited on each stock that you might buy to a maximum of, say, 32% gains for the day. And the reason for that is that once the stock goes up by more than 15%, with 15% of its reference price, that is, then the Jamaica Stock Exchange, the JSE, is going to halt trading within for that stock for a maximum of 1 hour. So they will halt trading in the stock if it goes up or goes down by 15%. They'll halt the stock and it will be released 1 hour after it was halted, and then you can then sell the stock and it's able to move up by another 15%. So if you look at a typical stock that would say be a running stock, a stock that is really running up in price, it might go up 15% and then halt, and then after that it can run up by another 15%. And remember, the maximum really that it can, say, go up within a particular day would be around 32-33% for the day. Any other trades above that will likely be cancelled by the JSE. And then lastly, we have the contrarian investor. And the contrarian investor is one who typically tends to just look for opportunities against the grain. So that's the person who is going to be buying tourism stocks, or stocks within the tourism industry within the COVID-19 pandemic, with the anticipation that these stocks are going to be worth well over what they're selling for now within, say, a 12-month, a 36-month time frame. And in fact, that's the expectation in terms of when tourism industry stocks will start to see their rebound, because they're going to take some time to recover from the losses that these companies are reporting. And that is going to create opportunities within the market. So already, even before we even get into the topic of how you cite opportunities, I'm giving you a little bit of hint as to how you can look for opportunities. But keep these investor philosophies in mind, because the philosophy that you have is going to dictate which opportunities you can participate in. And in fact, it might even, I'd go as far as to say, it will dictate what you might perceive as an opportunity. Okay? So let's talk. So given that backdrop, let's go into what we really want to talk about tonight, which is valuation and the identification of opportunities. Now, the key reason you might want to be looking at the stock market is because of the gains that actually exist on the market. So it's possible for a person to make hundreds of percentages if they're active on the stock market. Now, there are risks, and so you have to be careful when you're deciding to buy shares. So the first question really that you ought to ask yourself, if you're looking for opportunities, is when should you be buying shares?